Well, first things first. The first thing that needs to be pointed out is that the underlying goods flow continues to be strong, and that tells us that indeed this is only a correction, not a change in direction. It's when the underlying goods flow goes negative, and that's in every mode. It's still positive that we continue to get concerned or start to get concerned about the economy.
Feels like this group is more vulnerable to the trade war, especially with that warning out of UPS, Donald. Is that true?
Oh, it's absolutely true. And that's what I think the equities are trying to digest, because what we've got is strong goods flow. That's a positive for the group. We've got almost all of these companies beating and raising. That's a positive for the group. There's maybe a little bit of a potentially negative in that these are mostly capital intensive companies. And if interest rates go up, that's potentially a slight negative. But the real lingering issue is a trade war. A trade war, there are no winners in transportation. And so that's hanging over the group and hanging over valuations really of all of the different segments of transports.
If you consider those sub-sectors, those sub-segments, which is your favorite?
We really like, at this point, we like the logistics, the freight forwarding segment, and we like least the railroads, because quite frankly, they're probably the most potentially affected by a trade war. And those stocks really were hanging around their all-time highs just at the beginning of the month. They're only down 17% as a group. Versus the logistics, the freight forwarding group, and say those who deliver e-commerce, such as FedEx, which have already taken it a big dive. We're seeing valuations down 30 and 35% in those stocks.
How vulnerable are these companies that you follow to rising interest rates? That's really where some of the angst here started. Seems like a pretty capital intensive kind of business. How much borrowing is there?
Well, they're very capital-intensive companies. Many of them have fairly well-leveraged balance sheets. Again, that leads us back to logistics and freight forwarding, because there tends to be less leverage there, a much more generous production of free cash flow. So whether it's a company like an Echo or a company like an XPO, which although they have leverage, they're generating, it's because of a long list of very successful acquisitions, and they're generating copious amounts of free cash flow so they can, even in a down cycle, pay down debt.